Ireland's manufacturing sector contracted aggressively in April for a second consecutive month, suggesting Ireland may struggle to sustain its economic recovery. Joining me on the line to talk about this further is Anthony Baert, economist at ING. Thanks for joining me, Anthony. What risk does this negative manufacturing data pose to the Irish economy?
So first of all, this negative data comes from the Purchasing Managers Index, which is a leading indicator, so it points to the future and to what purchasing managers expect. This indicator has fallen for the second consecutive month, from 51.5 in February to 48.76 in March to now in April 48. So there's a downward trend, which indeed poses a risk to the recovery of the Irish economy. But we have to put this in a wider perspective. So first of all, the manufacturing sector is 25% of the Irish economy, which is still smaller than the service sector. And if we look at the service sector, that PMI index is above the neutral level and still rising. In April, it reached 55.2. That PMI index for the services sector. So this is one thing. On the other hand, the PMI for manufacturing is 48, which is negative, which points to negative expectations, but it's still not the level, the negative level which it was in 2008 or 2009. So it's a contraction, but it's not as bad as the global financial crisis, 2008-2009. So, however, yes, we have to take this into account and continue monitoring this trend.
This negative data suggests Ireland may struggle to sustain its economic recovery. Do you agree with this?
Yes, indeed, but we have to put this in a wider perspective. So it's not only related to the manufacturing sector. So if you look at the internal demand in Ireland, all the components, consumption, government spending, and investments, they have been declining since 2008. Right now they are stagnating a bit. So this is one side. On the other side, the net exports are slowing down. They have been increasing since 2008, but now they are slowing down, which is a source of concern, because Ireland is a small open economy which really depends on these exports. But due to the double dip recession in the Eurozone, this hampers Irish exports. So there are these two components, internal demand and exports, they point at problems for the Irish recovery.
Ireland's economy grew in 2011 and 2012 despite a harsh austerity programme as a condition for €67.5 billion in loans from the European Union and the International Monetary Fund. With this in mind, what are your forecasts for growth in Ireland?
Yes, so these growth data were mostly driven by net exports, so by what was happening outside of Ireland. The internal demand was falling. Right now, we see that these net exports are also slowing down. So I would be a little bit more pessimistic than the European Commission forecast. They forecast for this year 1.1 GDP growth, and for next year 2.2 GDP growth. I would rather say something like 0.7 for this year and 1.9 for next year. But of course, everything depends on the Eurozone recovery as well. So we have to be careful here.
And last week, Ireland's government lowered its economic outlook for this year and next, citing slowing demand for exports. But the government said it is still able to meet its bailout austerity targets. Do you think they will realistically reach austerity targets?
So yes, the main target is, of course, the general government deficit. Last year, they reached a deficit of 7.6 of GDP, which was well below the target, Troika target of 8.6%. For this year, it's possible that they will not manage to get the target, because the forecasted budget balance is exactly the target, namely 7.5% of GDP. For next year, however, the target is 5.1%, but the deficit is forecasted there well below at 4.3%. So this year they will maybe not manage to get the target, but next year they probably will. But we should not focus too much on these targets, because the European Commission has recently indicated that it will grant additional flexibility to countries, because it also sees that with the ongoing recession provoked by austerity measures, that this is also hampering economic growth and the economic recovery. Therefore, and also due to the increasing resistance of populations in the Eurozone, this led the Commission and also wider the Troika to be more flexible with deficit targets. So even though this year they will not manage to get it, I believe that Ireland will smoothly end its program at the end of this year.
That's all for now, but stay tuned to Dukascopy TV for the latest financial news and updates. Goodbye for now.